Look, it's a tough market out there, right? Everybody's thinking about liquidity. Our personal equities, our business-related equities are sometimes sort of kind of locked up, according to the public markets today. And so, come on up, guys. Come on up. Have a seat. Relax. We've got some great perspectives here. They're going to talk about different things like secondaries and M&A and all that. We've got Brent and Tyler from JP Morgan. Thank you guys for joining us. And Cheryl Goodman, who is not just an expert communicator. She's a Startup San Diego Vice Chair and has an interesting background that she'll tell us a little bit about as well. And so thank you guys for being a part of this. Thanks for sponsoring, and take it away.
All right. Thank you, Al. Yeah, so we recognize that we are the only thing standing between you and a cocktail and a sunset. So, and we also, we know that we're going to have a good time up here. You're going to get some fun facts to approach these guys later. Something good like Tyler Lay is related to the Lay's potato chip family in some way. He does not get free chips, though, just so you know, so don't ask him for that. So, but anyway, yeah, this is going to be a great conversation. It's global market outlook, regional implication, and where's the liquidity? And as Mike Kren had said to me earlier, if he's still around, it's not about where's the liquidity, where's the good liquidity, right? So we're going to talk about that too as well. But let me tell you a little bit about Tyler Lay, the chip guy, as it were. JP Morgan, vice president in the firm's Technology and Disruptive Commerce Group and Banking Solutions. He does structured financing, advisory assignments for technology, consumer, digital media, and innovation economy here in San Diego and Southern California. Really interesting background with regard to the films that he's helped, make come to the screen. If you're a fan of any of the products coming out of Legendaries, Lionsgate, and many others, definitely a very interesting and compelling background. So thanks, Tyler, for being on the board. And then we also have with us, we have Brent, who is with Sweetwater. Brent Grenado was managing partner at Sweetwater Private Equity. He also says he's a recovering attorney. So there's your in to talk to him after and get that cocktail and have a few chuckles with him. But he is an accomplished investor, board member, and executive with extensive knowledge in global markets with regard to technology, healthcare, and consumer products. So definitely we have the right guys to have the conversation. So let's start it off with, as Al had said, really, where are we? Where the status? It's a perceived as a tough market from an economic standpoint, but no better person to get that from than Tyler Lay at JP Morgan. Can you give us an overview of where we are at the market?
Yeah, for sure. I think, first of all, the firm view, I think Jamie, if you haven't read his letter to the shareholders, fantastic insight into how the firm thinks about, the broader economy and all the nuances therein. I think from my personal perspective and what I've been seeing and hearing in the market, unfortunately, it kind of mirrors what David was kind of saying earlier about it being rather gloomy out there. I think there's a number of macroeconomic headwinds that we're facing and will continue to face for the foreseeable future. You have, the debt ceiling debacle that's just starting to get really ramped up in Congress. You have commercial real estate with over $400 billion in debt that's looking to mature this year, with occupancy rates down and interest rates up. That's generally speaking not a good combination for folks looking to refinance that debt and the broader implications that it could have across the market. And then finally, you have the Fed and the rest of the central banks out there that continue to put us in a high interest rate environment, which makes things challenging, especially when we've all been accustomed to a environment of essentially free money over the past 15 years, right? And that's really what's fueled a lot of the boom that we've been seeing as it relates to the innovation economy and kind of the startups, right? Especially hard when we're coming off record years of 21 and 22, where we saw just an immense influx of VC dollars coming into the startup world. and it was easy to raise capital. You basically just show up with a pitch deck and they'll cut you a check for $20 million, right? Those times are gone. Really, it's become a challenging environment. There's still money on the sidelines, and people have to put those dollars to work, but they're actually doing a little bit of diligence these days. And they're actually reading your pitch decks and asking you questions, and they want to see this crazy thing called profitability, right? Or at least a path to it. So what that really means for folks looking out there to raise capital is you can find it. It's just challenging. You have to really dig in, and you have to refocus and recalibrate on the business fundamentals. Quality businesses with quality business models, they're seeing funding happen, and it's easier for them to get funded. Other folks have to show that path to profitability, and you have to look at runway extension and how you're going to actually make those dollars stretch and last. We're seeing, typical runway in between financing rounds from 9 months a few years ago stretch out to about 18 months these days. So that's how long folks are looking to stretch their capital. And if you look at the number of financings that were done between Q1 21 and Q2 22, for Series A, it was about almost 800 financings were done. And if you do the math, we're coming up on that 18-month mark pretty quickly for those companies. So there's going to be a number of folks out there that need to raise capital, and you have to make sure that you're looking back to your fundamentals and making sure that you're cleaning things up in preparation for those financing rounds.
Yeah, that's a great primer, and I would just flip it over here to you, Brent, is given those challenges that Tyler has laid out, what are the opportunities that maybe aren't so obvious, and especially in the secondary market?
Yeah, for us, secondary market's been pretty interesting because there's certainly those quality companies that Tyler mentioned out there, and that's where our focus has been. A lot of what we focus on, and I'll just give you just a ballpark, is we're looking for companies that are doing at least $50 million in ARR or revenue for that matter. And they're growing at a clip of, we've dropped this kind of to 30%. I think previously it was more around 40%. Understanding that companies do need to pull back quite a bit on their cost structures in order, and there is some growth that's going to hurt as a result of that. But what we're finding is there's still quality companies out there. There's a number of folks that are seeking liquidity in the marketplace. They could either be institutional managers that are on any one of your cap tables, hedge fund managers that went completely sideways in the last 4 years, dabbling in privates when they didn't belong there. Or for that matter, founders that have been obviously in their organization for a really long time. We will typically provide partial liquidity to those folks, knowing that there's a need for the managers. There's a need because they need to show liquidity to their limited partners. Otherwise, they will not be raising another fund anytime soon. For the founders, they put their entire blood, sweat, and tears into these organizations. Built something really special, but haven't seen really a dollar come out of it, effectively because they're still reinvesting or raising capital to keep going. The businesses, as Tyler mentioned, really do need to be, what is quality? What the flight to quality today is cash flow positive. And if you have a pathway to get there within the next, we'll call it 6 months, it still is a bit attractive to us if it's a very clear executable plan. But yeah, I mean, that's kind of the general aspect. And I think I hear like liquidity, positive liquidity. Some people don't view the secondary market as positive liquidity only because it's not a free flow of a trading marketplace like in the public markets. So there is always some form of a discount attached to that.
Right.
But once again, I mean, if you're operating a highly quality company, there's something to be said about also the difficulty of getting into those businesses.
Right. And I would just say in general, do you feel like this audience maybe needs a deeper dive on exactly how secondaries work? Like what would that look like transactionally to leverage?
Sure, yeah. From our perspective, but we do direct secondaries, which is a very, we'll call it a niche in the whole secondary market. A lot of people think about secondaries when they get to buying up LP interest or this new thing called GP continuation funds. That's not of interest to you. So our direct secondaries are helping alleviate those that have been on the cap table for quite some time. We do direct transfers with the organization. Those are usually really easy for us when we work with institutions because, as many of you know, they're preferred shareholders. There's no ROFR associated with those shares for the most part. The challenges do come when you work with common shareholders. And once again, founders are interesting at times. We've done founder transactions. Many times those founder transactions are because they have been a little more sophisticated or have had the ability, more importantly, to put capital into their business alongside other institutions or in their earlier stages with, call it the seed and the Series A. They're easier, obviously, to transact with because they don't have ROFR, once again. If we're talking their common shares, yeah, it can be a little challenging, but they still get done. It can still get done. It's just maybe you don't end up transacting with me. You may end up transacting with someone on your cap table because they have the right to jump in front of me once I make that offer.
Yeah, that makes sense. Thanks for unpacking that. If you want to dig deeper into that, we will do a Q&A at the last 5 minutes. We're already 10 minutes into the session, so let's get back to you, Tyler, and maybe you can unpack a little bit more of the primer that you laid from a national, international perspective. Let's talk about San Diego, and then Brent, please jump in to contribute to that. What do you see uniquely, if at all, about the San Diego market?
Yeah, I think, San Diego is going to be, caught up in the broader macroeconomic trends that we're kind of seeing, right? Like, we're going to be, kind of at the mercy of everything going on there. But I do think there is a silver lining with San Diego and what we've, been building down here for quite some time. I think there's starting to get some critical mass here in the San Diego market. Especially as it pertains to like the innovation economy and everything that has been built out here so far, where, especially post-pandemic, you've seen a lot of momentum of folks realizing, how special of a place San Diego is, not because we have, events like this and weather like this outside all the time, but because there is such a strong community here, especially as it pertains to innovation economy and kind of the startup world. And if we can capitalize on that momentum and continue to build, I feel like we are at a bit of an inflection point where we can kind of buck the trend of what we're seeing, nationally on the macroeconomic level and really start to get some momentum and build something that's pretty special down here. We just got to keep doing what we're doing and really focus on, I think, the community aspect, because that really is what is special about San Diego, is it is a community down here, and there's a lot of opportunity to build something that's really unique. Like, San Francisco being a tech hub makes no sense. The weather's terrible up there. No one really likes it. Like, San Diego is such a better alternative. As much as I kind of hate saying that, because I like having this kind of quasi-hidden gem down here, right? And I hate telling people about it because I want to keep it all to myself and ourselves, but it is just such a cool place and makes so much more sense.
Yeah, so our success is inevitable, right? We're not fully there yet, if I'm hearing you correctly. I mean, Brent, would you like to add on to that?
Yeah, I think with cheap money comes great opportunities. And what I saw with San Diego kind of starting back when I first was down in this area in 2012 was there were no funds. There were a number of, we'll call it angel investors, but there was no real ecosystem. Over the last number of years, moving forward, you've seen a number of venture funds start to plant their flag here. They're not the ones that are on Sand Hill Road, but they definitely are flying down here. We've seen financings down here with tier one investors over the last 5 years that would have never happened when I started in 2012. You see groups that are now starting to exit. Those exits will clearly create this virtuous loop of angel investors starting to reinvest into the ecosystem. I think we're probably only two mega IPOs away from turning this into a real standalone kind of ecosystem that can build and continue to build companies here.
Yeah, and they're probably in this room somewhere, right?
Absolutely, and
Right.
I think the thing I love about San Diego is when I first came down here, it's all biotech, right? That's all you ever heard. That's changed a lot, even when I'm in the valley quite a bit, and they're like, "Oh, you're in San Diego? Tell me more about what you're seeing down there." "Oh, I was just down there. Do you know this company?" So those things are happening a lot more often, where when I first started, they're like, "What? You launched a fund in San Diego?" So yeah, it's completely different now.
Yeah, and it's changing, but to your point, we're a few IPOs away. What would you add to that, Tyler? What else are we missing to really rise to that top-level benchmark?
Yeah, I think what you were mentioning around, folks that have kind of already gotten, kind of across the event horizon, if you will, continuing to give back and build and show the support for the community. That's kind of key to, helping it evolve. And then I think the next level is starting to get, really the attention at that national level of seeing those bigger funds and bigger folks kind of come in here and start to play in San Diego in more of a meaningful way. And I think you're already seeing that with folks, getting investment dollars from those, kind of larger, more marquee, traditional VC funds coming in here, and it's starting to put it more and more on the map. And I think as we get more and more traction and folks start to realize the great companies and great businesses that are being built down here, you'll see more and more of that. I think folks still think that they can cover San Diego from their office in LA, but that's not true. And I think people are slowly starting to wake up from that. I mean, take, for example, JP Morgan. We realized that not too long ago and really come down here and realize, what the opportunity is here and how special the community is and the composition of things. And so we're focusing more on it. I think you're going to see more and more folks start to realize that and really build it out.
Right, so FaceTime really does matter. At the end of the day, in this Zoom economy that we've curated due to COVID, you still need to have an office down here to make it happen, make it real.
But I do think that COVID helped a lot.
Yeah.
And I know that's strange to say, but I know a number of folks that lived in the Valley that moved down here. And they're not running around all that often, but I mean, some of the firms that you would know up on Sand Hill Road, there are definitely partners in and around this area. Now they've had to go back, but they have second homes and.
Right,
So
they've gotten a taste of San Diego.
That's right.
It's hard to leave
You're
after that.
addicted. You are addicted, absolutely. I wanted to touch on something that you had said, Brent, relative to the perception and partial fact that we are a big life science community, but we're also, obviously telecom, with Qualcomm being a major player in town. We talked earlier about the convergence of life science and hardware and tech and deep tech. I mean, what are the opportunities that you're excited about nationally in terms of technology investment, and what do you think is special here about San Diego? And I'm talking about that convergence of life science and hard tech, and the AI. Can you talk about that?
I'd be completely remiss not to mention AI and the most recent developments that have been happening around that. Obviously, AI's been around since God knows how long. Started with neural networks and has now moved into this whole large language model. All really exciting stuff, but the applications are where it's going to be next. And look, on the biotech side, you hear it all the time on the more pharma associated, how you're going to use the machine learning tools to help accelerate compounds and different mixes. And I'm not a biotech person, so I'd probably just stumbled all over those words. But I see San Diego, obviously, as this tech environment continuing to grow, where I was having this debate just a few days ago with some other managers, and is there a single company out there other than OpenAI that's 100% AI? And the answer is no. Is it a feature or a benefit to a company today? Absolutely. Are the language models dangerous? Potentially, not in the sense of like what Elon Musk is talking about, but just the ability to hack them and cause them to expose certain things about the way they were developed, whether it be saying something discriminatory or what have you. Yes. I've seen lots of companies that are public rushing to this. I've seen lots of private companies that are rushing to this. I even had a dialogue today with a public company about it, and they're a little nervous about their launches for their customers. I don't think their customers are aware of this, but there's a lot going on, and I do think that AI is being one of those. I think the convergence of hardware and software. You see a lot of the chips that are now being designed, whether it be by NVIDIA or those partners that are out there that are designing for AI specifically. I mean, the developments are insane, and Qualcomm's very much involved with this as well.
Right, and the pace just continues to accelerate, maybe even beyond Moore's Law's time frame, right?
Yes.
I mean, it seems like exponentially over Moore's Law.
Sure.
Tyler, given that you focus on disruptive commerce, I'd love your input on these same topics.
Well, we're seeing AI get more and more integrated and ingrained with everything, right? It's become a tool that is, as synonymous as a hammer, right? And it's something that you almost have to be involved in some capacity in your business. Everything from a startup clothing company is using it to figure out customer base, customer demographics, and how to even design their clothing, right? Like, it's getting integrated on that end of the spectrum, as well as on the other end of call it biotech or whatever, where they're actually doing very complex things that are quickly over my head to figure out, right? So we're seeing that quickly get ingrained more and more across the spectrum, just as kind of the folks that were on the panel earlier were saying. And it seemed like it sprang up overnight too, right? Like, we've been hearing all this talk of AI for quite some time, and how it's going to come and change everything. And then it seems like you woke up one morning and ChatGPT was here.
Right, November 2022.
Right, so it's interesting. I'm definitely curious to see how it really gets ingrained in a meaningful way. I know at JP Morgan we're doing a bunch of cool things kind of across the spectrum on it. One thing in particular that I think directly impacts the folks here is we're using machine learning and AI to essentially automate the capital raising process for folks, and have a platform that we launched about a month ago called Capital Connect that could be really impactful and really meaningful for helping companies raise capital in these more challenging times. And that is primarily driven by AI and machine learning. So there's going to be a ton of ways that AI is going to impact your lives on a daily basis, and we might not all even be aware of how many ways they're impacting them.
Yeah, I think back, go ahead, Brent.
I just think the one thing that I think is most interesting about this is probably every one of you has data and analytics that you're running, or data that you're capturing as part of your organization. And a lot of it has been captured for many different reasons. Some is you didn't think was actionable whatsoever. And I think this is the piece that's going to allow that to become actionable. And whether or not your initial revenue stream was what your current product is today, your data could be a completely different revenue stream later on. And that, to me, is what's most exciting about it.
Right. Yeah, I can't think of a single business model where this would not apply.
Yeah.
I mean, I'm sure there is one. Let's not go that way because we're not interested in that. So just checking in here. We got 8 minutes left on this panel. I'd like to get kind of one final comment from each of you. Really on we hear the doom and gloom every single day, but give us something optimistic about what you're seeing from where you sit relative to San Diego and the national economy. Where can we find hope? And then we're going to kick it off into Q&A for the audience. You want to start?
With it?
Sure, I'll start. So I'll start by saying in Q4 of last year, I get these newsletters every day about what's happening in the funding world, and they were about as dry could be. And I knew the financings that were being reported were done 6 months prior. Today, I'm seeing lists, and it's not back to what 21 was, and I don't know if we'll ever get back to where 21 was, but the lists are growing again. And so the early stage between seed A and even and seeing heating up in B is really a good sign. Hopefully that will continue. Obviously the choices around interest rate hikes and such may have a role in that. But I am seeing some good momentum in that side of things. I think the other side of it is, I know a lot of people are concerned about when is liquidity going to come again? The M&A market has been quiet. However, I talk with a lot of public companies quite often, specifically in the technology space, and they are definitely kicking tires now, and kicking tires in a way that are a little more meaningful than just nosing around. And then the last thing I'll say is the secondary markets are active. We have definitely been making investments. And so there are channels for liquidity on that side as well, and it's just a matter of what your interest is and what your appetite is for that. But there are positive silver linings in this cloudy storm.
Yeah, I think that's spot on. I think unfortunately it is going to get a little bit darker before it gets lighter. But same to everything you've been saying. There's definitely folks that are actively looking to kick tires and be acquisitive on things and really start that M&A dialogue and where they can, find the right opportunities for their business. And, I have a number of clients now that we're, beginning conversations around exploring, an exit into the public markets and what does that look like and, what's the timing of like that and how do we think about things on that front. So folks are realizing that there is going to be, light at the end of the tunnel and we need to start prepping for that and making sure that we're ready to capitalize on it when it does come. So, I think, we will turn a corner here soon and, we will have, access to more liquidity, especially once the Fed, actually starts cutting rates and maybe restarting some quantitative easing. That will definitely jumpstart things. But I think there's a lot of positive, stuff to come. We just got to get through kind of the darkest part of the night.
Yeah, all right, very good. All right, so 4 minutes till we call this a close. First question.
Yeah, we're talking about liquidity, so I have a very specific question. In the capital markets today, on the institutional side and also on the retail side, I'd like to hear your view on alternative trading systems, not just today, but in the future. We know on the institutional side there's billions of dollars being traded already on that side. I'd like to hear what your view is because we're interested, a lot of people in this room, is how do we get liquidity quicker, okay? Not waiting 7 years or never, as I like to call it. So I'd like to hear both your opinions about ATSs and where it stands. Thank you.
So the question was, how do you get to liquidity quicker? Tyler, do you want to start?
You sound like you're jumping a bit over here.
Back over to you, Brent.
As I was exhaling. Quicker is a good question. For us, as I mentioned, kind of the parameters as a minimum on our revenue thresholds and such is like 50 million. So I don't know how quick you can get there, but then we can start working with groups to provide that kind of liquidity. There are groups out there that are a little more, we'll call them risk-taking, that would be interested in providing liquidity through the secondary markets to earlier stage companies. I would say that probably comes at a higher cost just because the risk-reward is a different dynamic than what we're looking at. Other than that, like as we sit here today, from M&A would be the only other category other than financial buyers, of course, when you think about lower mid-market and mid-market buyout firms that are looking for opportunities. They are certainly have dipped below where their normal thresholds are for EBITDA, which is a potential opportunity as well. Look, I don't think companies are going to be sitting around for from an M&A perspective for probably longer than, we're not going to the 10, 11 year period most likely. I think a lot of companies are, some people are just ready to move on from that. And I think as we move actually more towards a cash flow positive environment where even your venture managers are trying to push towards being cash flow neutral and continuing to grow, that brings that strategic buyer in and it is potential that they're going to be more active.
Great. I think we have time for one more question in the back here.
Oh, the Capital Connect platform? Happy to dive into it a little bit deeper. I know we don't have too much time here, but you can catch me afterwards. But essentially, it's a platform that we've created to basically automate the equity private placement process that we do at JP Morgan. Because typically our buy-in was about $100 million before we'd even look at anything, right? Because the fee structure wouldn't make sense. But there's a huge market of folks looking to raise capital at smaller check sizes, right? And they didn't really have an effective place to go or an efficient place to go to find and source that capital. And so this platform that we've built is kind of all-inclusive. There's a cap table management kind of component of it through Global Shares, right? And then it's also big on data and leveling the playing field. And that's probably my favorite part about it is it makes what has historically been a very opaque market more transparent and more efficient, right? We've partnered with actually a company down here in San Diego, Omni, to provide some data for us on, what the VCs are actually doing and what they're looking for when they're going out and issuing term sheets, right? So if you're call it Series A company looking to raise some capital, right? Look, you're trying to raise $25 million. You essentially upload all your investor materials, et cetera, onto this platform. And, The VCs are also on the platform, kind of like a date matchmaking service. If any of you use Tinder or Bumble or anything like that, it's pretty familiar. I don't think there's a swipe function on it yet, though, but we might be building that in. So you upload all of that. It gives VCs the opportunity to basically, sort through what kind of business you are. Let's say they're looking for an AI business based in San Diego that's raising a Series A round, right? They can filter through, find your company that's raising capital, and they can issue a term sheet right there to you saying, hey, we want to cut you a check for $5 million, or we want to lead this round. And at the same time, when they issue that term sheet, you're able to go on the platform through our data and all the tools that we have on there, see what terms are market, what terms are not, and you can push back on that VC in some ways that you haven't been able to do so before unless you hired a very high-powered white shoe law firm that can give you kind of the inside baseball on things, right? So it really levels the playing field. It gives you access to investors outside of your region, especially in a region like San Diego, where it's kind of hard to get some national eyes or some outside capital other than some regional players. Gives you a lot broader pool and a bigger pool to really kind of access that type of capital in, and it also gives you a ton of resources to make sure that you're fighting a fair fight and not a David versus Goliath type battle. So it's a really cool platform, really innovative. Happy to chat with folks in more detail down the road. I know we're short on time, but thanks for the question.
Yeah, it's a great question.
Shameless plug, so appreciate it.
Yeah,
I swear I didn't
great.
plant that one.
All right, let's give it up for Tyler Lay, JP Morgan, Brent, Grenado, Sweetwater Private Equity. Thank you.